Welcome to the Deep Dive. This is where we take complex source material and really boil it down to the critical insights you need. Today, we're tackling Concordium. It's a layer 1 blockchain, and it has this really ambitious goal, becoming the go-to platform for regulated finance. We've got a lot of recent docs here, and the big question for you, our listener, is how do they actually do it? How do they mix transaction privacy, which everyone wants, with the kind of KYC/ML compliance that regulators demand? It feels like walking a tightrope.
It really is the central problem, isn't it? The traditional public blockchains, well, they tend to be one or the other.
Yeah.
Either totally transparent, which kills business privacy, or fully anonymous, which regulators just won't accept. Concordium's claim, the really interesting part, is that they solve this right at the base layer, the protocol level itself. They mandate identity verification for every single account. That's different.
Okay, yeah, that is different. So let's unpack that. We need to look at, well, 3 key things, I think. First, how does that identity layer actually work? This idea of revocable anonymity. Second, what about performance? They talk about being enterprise grade, so predictable costs, speed. We need to verify that. And third, what's the real world traction, especially with these July 2025 updates we've seen? And how do the tokenomics, the CCD token, fit into this whole PayFi or regulated payments picture? Right, let's start with that identity layer. It's public, it's permissionless, anyone can use it. But you're saying every account needs a verified real world identity attached. That seems quite counterintuitive for crypto.
It is. It's definitely their foundational design choice. But here's the key insight for you. The personal identifiable information, the PII, your name, address, that sort of thing, it's never actually stored on the blockchain itself. It stays off-chain. It's held securely in your own wallet under your control, and also with the identity provider, the IDP, who did the initial check. So that immediately tackles that big privacy concern about public ledgers exposing everything.
Okay, PII is off-chain, secure. Got it. But then how does the accountability piece work? If, say, there's suspected financial crime linked to an account, how can authorities find out who's behind it if the data isn't on the chain? This sounds legally complicated.
It is, and technically complex, too. It involves 3 distinct types of entities working in concert. You've got the user, obviously. Then the identity providers, or IDPs, they're the ones who verify you initially, off-chain. And then crucially, you have these privacy guardians, the PGs. These are independent, trusted third parties, often law firms or regulated financial entities. Their job is critical because they hold specific cryptographic shares. Think of them like keys needed to unlock the link back to the real-world identity.
So if law enforcement needs to identify someone...
Right, this is the revocable anonymity mechanism. It's built around legal due process. An identity can only be revealed if a proper qualified authority, like a government agency or court, gets a valid court order. And that order has to go to both the IDP and the privacy guardians. It's only when a majority of these PGs, right now the threshold is 2 out of 3, agree the warrant is legit, that they release their cryptographic shares. These shares are then combined to reveal something called the public holder identifier, which the IDP uses to retrieve the actual identity record.
Wait, let me just break that down. So no single entity, not the IDP, not Concordium itself, not even a government on its own can just decide to unmask someone. It needs a proper legal order plus cryptographic agreement from multiple independent legal firms. Is that the firewall?
That's precisely it.
Yeah.
It's designed to embed legal due process directly into the protocol's operation. Instead of just code is law, it's more like legal process is enforced by the code. It's a very deliberate attempt to bridge that gap between, the crypto world and traditional finance rules.
Okay, that makes sense. And for everyday transactions where you don't want any identity revealed, that's where zero-knowledge proofs come in, ZKPs.
Exactly. ZKPs are the engine for day-to-day privacy on Concordium. They let you prove something about your identity without revealing the identity itself. For example, you could prove, yes, I am over 18, or yes, I qualify as an accredited investor, without showing your actual birth date or your financial statements. The proof verifies the claim without leaking the underlying data.
That sounds incredibly useful, especially for this PayFi idea, regulated payments. I saw something in the notes about a one-click verify and pay feature.
Yeah, that's a great practical example. Imagine a merchant selling something age-restricted online. Using ZKPs, they can confirm the buyer meets the age requirement instantly during the payment process, without ever needing to see or store the customer's date of birth. That cuts down massively on data liability for the merchant, while still meeting compliance rules. And beyond that, the identity layer supports things like Web3 ID standards, so you can use verifiable credentials for stuff like proving you're an accredited investor for certain financial products on-chain.
Okay, so the identity, privacy, and compliance angle seems well thought out. But what about performance? Institutions need speed, reliability, and importantly, costs they can actually predict. How does Concordium deliver on that?
Right, shifting gears to the technical side. Performance comes from their own consensus mechanism called Concordium BFT. It's a proof-of-stake system, a BFT-style protocol. The big takeaway here, especially for finance, is instant finality.
Instant finality. What does that mean in practice? Like, how fast is instant?
It means a transaction is confirmed and absolutely irreversible, immutable, in roughly 2 seconds, maybe slightly less sometimes. That's a huge difference compared to, say, Bitcoin or even Ethereum's probabilistic finality, where you might wait minutes, even longer, to be really confident a transaction won't get reversed or orphaned. For moving serious money or settling important contracts, you need that immediate certainty. 2 seconds gives you that.
2 seconds is definitely fast. But the other big hurdle for businesses is cost. Gas fees on other chains can go absolutely wild, making budgeting impossible. How do they tackle cost predictability?
This is another really key design choice. They've effectively decoupled the transaction costs from the price volatility of their native token, CCD. Transaction fees are fixed in real-world currency terms, specifically in euros. So a basic transfer of CCD costs roughly 1 euro cent 0.01. That's the target price.
Okay, 1 cent fixed in euro, that's predictable. But the price of CCD itself fluctuates on exchanges, right? So how does the network charge a fixed euro amount using a variable token?
They use an oracle. This oracle constantly feeds the network the current CCDER exchange rate, pulling data from reliable sources like CoinMarketCap, CoinGecko, and others. So if the market price of CCD goes up, the network automatically requires you to pay fewer CCD tokens for that transaction to meet the euro 0.01 equivalent. If CCD's price drops, you pay slightly more CCD. The end result for the user is always that stable euro cost. This predictability is fundamental for any business wanting to use the chain, especially for payments for PayFi.
And this focus on payments also ties into their special token type, right? Protocol level tokens or PLTs.
Exactly. PLTs are a core part of their strategy, particularly for things like stablecoins. Instead of deploying tokens as layer 2 smart contracts, which, can sometimes have vulnerabilities or higher gas fees, PLTs are built directly into the base layer, layer 1. You can think of them almost like native assets, deeply integrated into the chain's operating system, designed specifically for payment tokens and stablecoins.
Does being built in like that make them inherently better, safer, or cheaper?
Generally, yes, both safer and cheaper. Because there are features, things like initial supply, whether they can be minted or burned later, compliance controls like allow or deny lists for transactions are defined right at the protocol level when they're created. This gives them a higher degree of security assurance compared to a custom smart contract someone just deployed. And because they're native, transactions using PLTs benefit from the network's standard low, predictable euro-based fees. Plus, critically for the regulated space, issuing a new PLT currently requires approval from Concordium's Governance Committee. That adds another layer of oversight that institutions often look for.
Okay, the tech sounds robust, the compliance angle is clear, so where's the adoption? Are real businesses actually using this, especially following those updates from July 2025? Is the PayFi vision becoming reality?
Well, the recent updates definitely focused on broadening access and demonstrating that PayFi use case. On the access side, getting CCD listed on Kraken was a big step. That opened it up to users in over 150 countries, importantly including the US and UK, which are key regulatory markets. They also integrated Banksa directly into the Concordium wallets. This means users in, I think it's over 130 countries, can buy CCD pretty easily using regular payment methods, Apple Pay, Google Pay, bank transfers, that kind of thing. That significantly lowers the barrier to entry for everyday users globally.
So easier for people to get involved. What about businesses building on it? Who's using it for this regulated payments, this PayFi stuff?
We're seeing movement, particularly around stablecoins, which makes sense given the PLT structure. They've got partnerships with StableR. They're issuing institutional-grade euro and US dollar stablecoins on Concordium, and also VNX, focusing more on non-USD stablecoins, again, targeting compliance. These issuers specifically leverage that built-in identity layer. Beyond stablecoins, look at the enterprise side. The car manufacturer Geely, a huge company, co-built a blockchain service network in China using Concordium's tech. They're using it for things like tokenizing supply chain invoices and enabling instant payment streaming between suppliers. That's a pretty strong validation in a complex, high-volume environment.
Geely. Okay. That's significant. Any other areas?
Even in related fields like Web3 gaming, which sometimes struggles with compliance, there's traction. Panenka FC, it's a fantasy football platform, apparently scaled past 100,000 users and processed over 70,000 transactions on Concordium. It shows that having an identity layer doesn't necessarily kill user growth. It just channels it in a more accountable way.
Right, so real adoption is happening. And that adoption presumably fuels the network's economy. Which brings us to tokenomics and governance. Let's talk about the CCD token itself. It's used for staking, security, paying those euro fixed transaction fees.
Yes, CCD is central to everything. It secures the network through staking. Validators use it, delegators use it. It's needed for transaction fees, governance participation, and obviously underpinning these PayFi applications we've discussed. The tokenomics plan is designed for the long haul. The Concordium Foundation has stated a goal to gradually reduce the rate at which new CCD is created, the minting rate. They started higher, around 10% annually, but the target is to eventually bring that down to a sustainable 2% per year. It's about shifting from growth incentives to a model sustained more by actual network usage fees.
I saw that they already made a cut effective back in December 2023. They dropped the rate from 10% down to 8%. Why did they do that then?
That move basically signals confidence from the governance committee. They looked at the ecosystem growth, the traction we just talked about, and maybe more importantly, the large amount of CCD already being staked for security. With a strong security baseline established, they felt comfortable taking that first step towards the 2% target. It reduces inflation slightly, which is generally seen as healthy for a token's long-term economics, while still keeping staking rewards attractive enough to maintain network security.
Okay, speaking of staking, for you, the listener, maybe you don't want to run a full validator node that requires a minimum of 500,000 CCD, which is substantial. How does delegating your stake work? How do you earn rewards?
So the rewards primarily come from two places. 90% of all the newly minted CCD goes towards rewards, and 90% of all the transaction fees collected also go to rewards. These are distributed among the active validator pools. Now, for smaller holders who want to delegate, Concordium has this rather unique feature called passive delegation. Instead of picking just one validator pool to delegate to, which carries the risk of that single pool underperforming or going offline, passive delegation lets you effectively spread your stake proportionally across all the active validator pools at once, automatically.
So it's like built-in diversification for staking. Reduces your risk.
Exactly that. It smooths out performance and minimizes the impact if any single validator has issues. The trade-off for this convenience and risk reduction is a fixed commission rate, currently 25% on the rewards earned through passive delegation. This commission is then distributed back to all the active pools, helping support the overall health of the validator network.
Interesting mechanism. Okay, finally, let's touch on governance. Given the focus on compliance and the initial role of the foundation and these privacy guardians, how is Concordium handling decentralization, especially with this governance committee structure?
It's a phased approach, definitely gradual decentralization roadmap. They're currently in what they call the second phase, which runs from mid-2024 through to mid-2027. The governance is shared between the Concordium Foundation, the Governance Committee, or GC, and ultimately the CCD holders. What's happening right now, as of June 2025, is that CCD holders are actually in the process of appointing 2 more members to that governance committee. This expands the GC from 7 members to 9, and critically, it means 4 out of those 9 members will be directly appointed by the CCD holding community. On top of that, they're rolling out mechanisms for CCA holders to formally vote on certain technical proposals that come from the GC. So it's a measured handover of power, trying to balance the need for stability and regulatory alignment with the crypto ethos of decentralization.
Okay, so pulling all this together, Concordium seems like a very deliberately engineered platform. It feels like every major design choice, the mandatory identity layer shielded by PGs and ZKPs, the fixed euro transaction fees, the PLTs, it's all aimed squarely at making blockchain tech palatable and genuinely useful for the existing regulated financial system, not trying to replace it overnight.
I think that's the core insight for you to take away. They've identified that friction point, the clash between crypto's norms and regulatory reality that has really stalled big institutional money from moving onto public chains. They've tackled it head on by building this framework of privacy with accountability. That design inherently makes it a much better fit for things like large-scale regulated payments, PayFi, stablecoins, and tokenizing real-world assets where compliance is non-negotiable.
It's a fascinating approach. And thinking about their long-term economics, that leads to a pretty interesting final thought for you to consider. We know they've cut the CCD mint rate from 10% to 8%, aiming for 2% eventually. As the network relies less on these minted rewards and more on actual transaction fees for its security budget, what level of transaction volume, especially from these PayFi use cases, will they actually need to generate enough fee revenue to keep the network securely running once they hit that stable 2% inflation target? That future balance between transaction volume and security costs will really show if the economic model can sustain itself long term.